Hello and welcome to a brand new show of Market Makers. Exactly a month ago, it appeared that world is going to end and a financial crisis was about to hit us. But suddenly, all the growth concerns, all the global concerns are getting arrested and they're getting addressed. Chinese or devaluation of Chinese currency is no longer a real fear. Crude prices have stabilized and Fed has clearly indicated the kind of interest rate trajectory they are likely to follow. Globally, the mood seems to be risk on and all major markets have rallied from the recent lows by about 5 to 10%. So where do we go from here? What about earnings, valuations, and can global growth concerns haunt us once again somewhere in 2016? Let's discuss all that and much more with one of my favorite market commentators, Neelkanth Mishra of Credit Suisse. Welcome to the show and thank you for joining us.
Pleasure being here.
30 days and the world has taken a 180-degree turn.
Yes, because a lot has happened. If you look at it from the Indian perspective, there was this concern that that the government could expand its fiscal deficit, the bond yields could go up, and we could see a potential repeat of what happened in the middle of 2013. So that's behind us now. What also seems to have happened is that the Chinese growth trajectory now seems to be stabilizing. Now we can question how sustainable this is going to be. But there is news coming out that the infrastructure investments are picking up again. And in the second half, metals demand and materials demand from China could actually start improving again. What has also happened is that the growth slowdown that was feared in Europe and the US doesn't seem to be as extreme as it was. And the policymakers have also been fairly supportive. So I think the fault lines that existed in the world, I think they still exist, but they have faded. And so for the next 3-6 months, other than possibly the European migrant crisis, I don't see any serious sort of crisis risk that exists right now. I mean, they still exist over a 1-year period because things can still go wrong. But for now, the market would feel quite relieved.
So can I safely say that when we started the year, markets thought that there could be a financial Armageddon? The financial news or the economic news has not panned out as markets were pricing in.
Correct.
And now there is a repricing of risk.
Exactly. And some of that sell-off, I mean, if you remember our past discussions, it was also about just someone, some sovereign wealth fund or some desperate selling because they needed funds. Now, the market always ascribes a reason to it, and the reasons perhaps were being concocted. And perhaps the probability of a crisis was made to be much higher than it really was. And so now that sell-off has receded and commodity prices have improved a bit, there is some stability.
You were the first and I guess the only market commentator who went and recorded and said that Indian markets will only bottom out when crude prices they bottom out. And again, it has moved out exactly the way you indicated.
Yep.
The day crude bottomed out, a week after that, Indian markets they also bottomed out. Now that it appears that we have a firm trading bottom in crude, can I safely say that for Indian markets as well?
Yes, I would say that as well. I think at least for now, so there are still. If I
this
look
for
out,
now is a tricky statement.
No, so 12-18 months, I think there are still risks that exist. I mean, all the risks that we worried about, a big global commodity trading company or a metal producer going bust, or a serious contagion risk or a serious RMB devaluation. Now, for the next 3-6 months, I think we can be reasonably sure that those risks have been pushed out. Have they been pushed out forever? I don't think so. So the volatility, I think, will persist. But for now, I think I don't see any reason to fear crossing 23,000, 24,000 on the downside, on the Sensex.
So something dire has to happen or something new has to happen for market to retest the recent lows.
Correct.
Ultimately, markets, they focus on growth and earnings. And that's where the big question mark is. We may talk about world repricing risk and liquidity is making a comeback, but then some basic questions would be asked. It could be asked today, it could be asked tomorrow, but they would be asked that where is growth and where are the earnings?
Growth, and we have discussed this in the past as well, I think in India is actually doing pretty well. And I'm surprised to see, I mean, I was part of a panel recently where I was surprised that I was almost in isolation. I mean, I was the only one saying that, no, we're actually doing quite okay, because everyone seemed to think that growth was slowing and that FY17 could see downside risk to growth, which I think is completely inappropriate. If you see even February oil demand growth, it was 11.7%. Right? Even two-wheelers, which were earlier growing slowly, are now finally showing some strength. And this is despite the fact that there are large parts of India which are really reeling under drought, and agricultural economy is actually under stress. So, so I think the economy is actually doing very well. There is good growth. If you looked at the December quarter earnings, indeed there are about more than a third of companies which have seen their operating profits decline, but there are a fourth of companies which have seen operating profit grow above 30%. Right. So, and if you see the characteristic, I mean, so there are always exceptions here and there, but generally the companies seeing earnings decline were the ones that had global exposure. The ones that had 30% plus growth were the ones which had domestic exposure. There were some pharma companies exports, but now, so I think there is still good growth. And I think that as the year progresses and more signs of growth start becoming clearer, like in December, January, we still had doubts about cement volumes. But the last month or so, we have seen cement volumes year on year at least revive as well. It's on a weak base, but so what? I mean, there is good growth. And so I think there is good growth in India. And those are still the sectors that I would continue to be on, because they can be a risk rally. They can be a revival in all the global exposure sectors that, oh, look, Chinese metal demand is going to pick up and so on and so forth. There can be a trading rally in those stocks, and there can be a vicious trading rally in those stocks. But would I rather be in something that is going to be with me for much longer, is much safer? I would rather prefer a safety and domestic growth than try to trade the rally that is going to happen in the global sectors.
So what's happening in metals or maybe in some of the cyclical stocks, according to you, is just a dead cat bounce, more like a dash for trash?
I would not call at this stage, given what's how strongly things have changed in China. So actually, so if you our global or our Chinese metals analysts just had a very interesting tour, and what seems to be happening is that the comfort that local domestic or local officials have on approving projects is now much more than what it was, say, a year back. So there is support from the center that you can push for growth. And the number of infrastructure projects, property is still a problem, but infrastructure projects that are going to start off, and they have started, they will start reaching that stage where they demand metals in the second half of this calendar year. So there is a change. I think there is a serious change. My worry with the metal space in India is the high leverage. So you can trade. And this is not dead cat. I don't think this is a dead cat bounce. This is the dead cat bounce will last 2-3 weeks, right? I mean, or maybe a month. But this, I think, can possibly be longer than that. But that is still too risky for me, because if you have such high financial leverage, you have such high levels of debt. Unless you use this opportunity, this bounce in the stocks, to really pare down your debt, you're still a risky stock. And I think we all know by now that what the Chinese government is doing in terms of infrastructure support is more to stabilize the economy. This is not a repeat of 2009-10. And again, this is not the way it's going to be, say, 2 years out. So no one can put a claim that steel demand in China will be higher than now, say, 3 years down the line, right? We can't make that claim. And therefore, I would rather avoid these sectors because they're too dangerous in terms of their balance sheet and so on and so forth. But I think the bounce can perhaps be longer than what you would call a dead cat bounce.
You've argued in the past that don't buy financials, and you've pretty much said that buy private banks but don't buy PSU banks, and within private banks also remain underweight on financials as a group, which is the largest group in India.
Correct.
Now that was a outlier call, but that call so far has worked.
Yes.
Would you still like to stick your neck out and say remain underweight on financials?
Yes, I think there is a very concerted effort and a very heartening approach from all the three entities, the Prime Minister's Office, the Ministry of Finance and the RBI, in resolving these issues. And no one seems to be coming with any side agenda, let's save this group and so on and so forth. They all want a theoretically rigorous solution to this problem. And I can tell you from my vantage point that India is one of the few countries which is actually going out and cleaning up its banking system. Other countries are not even started down this path. So we are much ahead of others in terms of resolving it. I think the resolution will happen. There is complete sincerity on all three fronts. What is not clear yet is how to go about doing that. So maybe the bankruptcy bill passes and maybe there is a greater fear among promoters and there is faster settlement and all of that. But I think for the next 3-4 quarters, you will continue to see bad loans getting recognized, earnings getting revised down, book value getting eroded for many of these banks. So while it is medium-term healthy for the economy and for the banks perhaps as well, I think it's going to be very, very turbulent in the next 3-4 quarters. So I would still stay away.
But it's often argued on Wall Street and D Street is that a good business at a bad price and a bad business at a good price, go for the business where prices are good.
Yes.
Are prices good in banks now?
In some of the banks, yes, I can't name them, but because of regulations. But in some of the banks, I would say yes. If you're willing to sit through the turbulence for the next 3-4 quarters, I think the prices are actually
Is
not
your
bad.
tilt towards wholesale banks or tilt towards retail banks still?
No, I would still be tilted toward retail banks because the retail banking opportunity is massive. So you have to understand that the government has effectively signaled that we are going to let the PSU banks grow.
Okay.
And so the opportunity that emerges because of that they're receding and the fact that they don't have capital to grow is massive. I mean, you're going to see 20% earnings growth compounded for a long time. There is a price to book multiple that already exists, but I think that opportunity is very strong. So I would stay overweight those stocks.
You've been a big votary of India's demographics and the consumption trends, and now the entire consumption sector will get its biggest kicker, which is the pay commission implementation and the benefit which will get to the OROP benefits. How will that translate into consumption demand, trend change and revival?
So the first thing first, we have been highlighting that state governments are much bigger employers and therefore it's much more critical as to when the state governments implement the pay commission. So far the budgets that have been presented, and most states have actually presented, very few seem to have provisioned for the pay commission in this year. Now that does not mean that they will not implement it this year because they will all be waiting for what the central government comes out with. And there are some states that have presented interim budgets, so when the final budget gets presented in June, July. So the pay commission impact could come 3-6 months later than what we had earlier expected. But still it exists, and I think the bigger change will be in the more non-discretionary sectors, autos, housing, and because of housing in cement, because the government employees are in the top quarter of urban consumers. So what that means is that their basic needs have already been taken care of, so they're eating enough.
Roti kapda makan.
Roti kapda makan has been taken care of. And so what they do after that is what you call the positional goods. So you can actually drive a Nano, but you would want to drive a bigger car. You can actually grow up in a 2-bedroom house, and I never felt it was small, but now everyone thinks, maybe 3 is better or 4 is good, right? So those are positional goods. I mean, you always compare what's the other person doing, and positional goods are what will see a surge in demand. You can also see upgrade cycles happening in staples. So people going from, say, a lower end detergent to a higher end detergent, lower end cream or a shampoo to a higher end cream and shampoo. So that upgrade cycle, I think staples companies have seen the last 2 times, and I think that will happen this year as well. But I think the biggest impact will be on the discretionary side, on the positional goods, things like cars and housing. And then also cement, because I think the real estate markets outside the top 50 cities moves completely around pay commissions. Because those cities exist only because there are government employees in that city. Right? So here, if the financial markets do well, there is some wealth. In Bangalore, if the IT market is doing well, there is some wealth. But in small towns, which only exist because the Tehsildar, the DM, the SP, the Sessions Court, so they are sitting there. The only point of time when there is a big cash infusion is the pay commission. So we can now perhaps expect a 6-month lag in what we had earlier expected. But I think it's coming. It's coming and it can be big.
If I look at historical trends, we've never had 3 bad years of monsoon. We've had 2. If God is on our side, if luck is on our side, hopefully it will be a good year of monsoon, and that's what geographical trends are also indicating. So can I say that it's never looked that good for agri stocks, both in terms of geography, positioning, and also in terms of the government ideation?
Look, I am not... my reading of statistics, and of course I never did as well as I wanted to, but my reading of statistics is that chances of a monsoon don't get affected by what happened in the last 2 years generally, right? So we can have a first in a century situation where you see 3 successive bad monsoons. And the good and the bad monsoon definition itself, I mean, so which region? I mean, are you talking about Marathwada, you're talking Vidarbha, and are the irrigated areas getting affected? Now, you've seen even power plants in the east getting shut down because there's not enough rain and not enough water. So, so I do hope and pray that the rains this year are good because we desperately need them. If they were to come through, I think yes. I think you will see not necessarily just the agri stocks like say the tractor producer or the tiller producer or some pesticide company, but also in terms of just I think rural housing. I think the rural demand. So staples companies with rural exposure. We have still seen growth. So rural is still doing okay. It's not doing well, but it's doing okay. Agri has been hammered down, and I think there's another aspect which can play potentially in our favor is that so I would so let me answer the first question again. That first is that statistics perhaps is not the best thing. What is perhaps more supportive of decent rainfall is that El Nino is receding and La Nina is coming up, right? So now La Nina actually creates weather disruptions. So like in Vietnam, in Thailand, we're already seeing situations of drought. That boosts global agri commodity prices. And that, I think, just shifts the terms of trade between urban and rural India, right, or agri and non-agri India. And I think that trend is also a very interesting one. And that's also supportive of the fact that, so if rice prices, wheat prices, cotton prices globally were to revive, or milk prices were to globally revive, you will see, I think, rural consumption in general do very well. And agri as well, of course.
So bent towards NBFCs, bent towards rural NBFCs.
Yes.
You've argued this one in the past that NBFCs will gain lion market share of this financial disruption right now.
Exactly.
But some of these NBFC stocks are also richly priced. I can keep some gold NBFC stocks aside, throw out a Mahindra and Mahindra financials, but the good quality ones, a Bajaj Finance or the good ones are expensive. So is there money to be made there?
Yes, see no, so there are a number that we have downgraded on exactly those reasons. So, I share that concern. What I think about the valuation in general is that just looking at high P or low P is perhaps simplifying it too much. I mean, if it was that simple, then we just need machines. We don't need people to be. So there has to be some nuance, certainty of earnings growth. So a high P by itself is not damaging. Risky. What it does, the high P doesn't mean that you lose money. High P means that the risk element is higher, right? So that a small disruption on the management or in the business model, and you suddenly see a massive loss, and that we have to keep in mind. But so long as you see a certainty of earnings growth, so long as you see perhaps an acceleration in earnings growth, which is possible in many of these stocks, the high Ps can be sustained. Which is why, for the last 5 years, we have been overweight staples, and they are very expensive stocks. I mean, I can see the PE as well. I mean, people point me, these are so expensive. I can see that as well, But so long as you see a certainty of earnings growth, so long as you see perhaps an acceleration of earnings growth or hope for an acceleration of earnings growth, I think the stocks will stay elevated.
And just for the benefit of our viewers, I always like to enumerate the example of HDFC Bank, that it's an expensive bank, yet because of certainty of growth, the stock has been one of the best outperforming stock. Yes. So where are you certain, confident and reasonably sure of the earnings trajectory?
No, I think, so there are multiple ways of slicing the cake. So the first is domestic versus global.
Okay.
I think the certainty of earnings on domestics is much better than it is on global. Within domestic, if you are, and as we discussed earlier, if you're in a bank that perhaps has a good part of the business, but also has pending bad loans where the regulator is going to get them to recognize losses, and they've not been doing that. They should have been doing that. The earnings. So then you are focused on, again, the same old. And people tell me my model portfolio doesn't change too much. I would like it to, but. So I would stay focused on consumption, retail-focused banks, IT, pharma, because there is a certainty of earnings that you can see there. And I would also add, and we have done that in the last 6 months, we've added utilities, because what's happening on Uday, what's happening in terms of the commissioning of projects for some of these large public utilities. So what that means is that the earnings growth can actually be very supportive, and these are stocks actually which are still cheap. They are surprisingly cheap. I mean, even oil marketing companies. See, the fact is, earlier, all you needed about oil marketing companies, all you knew about oil marketing companies was their book value, because the earnings were decided by two bureaucrats in Delhi. And so the market viewed them on price to book, valued them on price to book. Now, the half of the earnings that come from the marketing of oil, diesel and petrol, is actually doing well because oil volumes are very strong. And there is some certainty, so the multiple expansion there can be quite meaningful. These stocks have still not done as well as they should have. I think there is a lack of trust, but they, I think, provide very good value. They have 4-5% dividend yield, low PE, good protection, and good volume growth. So those are again sectors that I would focus on.
I'm going to just turn the table and let's go back to the global cues once again. Last 12-18 months, we've only discussed bad news, whether it is Brexit or what will happen to China or the future of commodity and the Middle East world. When will we start officially discussing good news?
I think the good news is very much the fact that there is no bad news. I mean, if you look at the European economy, I mean, some people joke that if your happy news is that Europe is growing at 1%, then you seriously have a big problem. But the point is that they are still growing, and despite all the disruptions that we have seen, the US is perhaps not going into recession, which I think is itself pretty decent. And I think you will see risk appetite coming back, and then suddenly, as the market's risk appetite goes up, the attention and the highlighting of positive news will also start coming up. And that's actually, India is a very classic example of that. That, credit growth picks up, and because of that, liquidity tightens. I mean, everyone used to wait for February, March, when the banks were desperate for liquidity and they would buy these FMP products. So we are used to the fact that the liquidity is tight, but when liquidity tightened this year, we all went back and started blaming, the states are borrowing too much and this and that, which we can discuss separately. But the point is, credit growth has started to normalize and it is picking up. And that's a good sign. But because the markets have been down, they want to focus on the negative side of it. So I think that will also start to happen. The good news will start getting highlighted a lot more.
Closing comments, we very fondly used a famous line given by Prime Minister Modi, "Achhe din." Haven't used that for Indian markets in a while. When do you think I will use it?
Achhe din, if you define as the Nifty and the Sensex breaking new highs, I think that's some time away. Okay. If you define Achhe din as at least some stocks and sectors touching, or more stocks and sectors going to their lifetime highs and so on and so forth, I think you will see that over the next year. You will see lots of stocks reporting 20-30% profit growth and doing very well in the coming year.
I'm an optimistic person. For me, achhe din is that we've recovered from the recent low. World is not looking that fragile. When we go to a new high, it would be bahut achhe din. Really appreciate your time. Glad you could join us.
Pleasure being here.
That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for tuning in.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.